Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside of Willow's control. Past performance is not a reliable indicator of future performance.
Okay, so I'm going to get started. Let me share my screen so I can get to the presentation. So as we often do, we show you our proprietary volatility index. This accumulates a variety of volatility indexes that we look at in economic data. So we decided to pull it together into one data point, even though Paul and I will separately look at each data point underneath this volatility measure. But nonetheless, for us, it's just a little easier when we present to just show the overall look, because this takes about 32 pieces in consideration. So you can see, the trend, and this isn't anything I think of surprise to anyone, because what we're experiencing in the market, one day up, one day down, very typical, very contingent upon the news of the day, or really the news of the moment today. That's how it seems to be. It depends upon what's breaking at any one particular time. That's very typical when you, especially as we near what I would say the end of a bull run. I think we're pretty close to that. Credit default swap spreads. Again, this is a very important indicator for us and for me to tell us how much risk is in the system. So you can see across the board, credit default swaps, not across the board, but pretty much, yeah, because even the bottom tick is still relevant, but you can see the direction is higher, not enough to make us jump up and down, but it's about direction really about direction more than even the hard number itself. And then here you can see with, again, risk, these are risk measures, and you can see that bond yield, the spread in bonds is rising. So that's mostly you're seeing that in the high yield space, which is typical, just so you know. Typically high yield space is spreads will move up first there, then you start to go down in the credit quality ratings, then you'll start to see it hit other areas, and you're starting to see that clearly take place. So one of the things I want to talk, if you remember back, if those of you were present for the webinar that I did in solo in September, beginning October, there was a slide we had in there talking about what keeps us up at night. And this is literal. Like, I will get up at 3 a.m. often, not, just, I go to bed early enough, but 3 or 4 a.m. and just really mull these things over. But one thing that I continually talk about is power consolidating to the top. And we see this across the board. Even it's happening in corporations. You can see companies like Amazon and Walmart, they're just becoming behemoth. And so you're seeing not just consolidation within industries and within sectors, but you're also seeing it in income disparity. So really, you're seeing the haves and the have-nots. I've been talking about this for a very long time. In fact, those of you who've been with us for the last decade, since our 12, 13 years since we've been a company, you will know that one of the things that I keep pounding is that this consolidation becomes very destabilizing, very destabilizing. You cannot have a gap that wide. If you look in history, just looking in history, if you look back, when you start to see these gaps widen, this is when you start to see more civil unrest. And I think it's very fair to say that we are absolutely seeing that. So let's say oligarchies are being created and oligopolies are being created. So fewer, in certain industries, you'll see fewer players, less competition. And then, the haves are it's consolidated. There's a number of reasons for this. We can go into it, but my feeling is if I spotted these trends back well over 2 decades ago, that this consolidation was taking place. And you can certainly see that. Like an example that I can give you is the telecommunications sector. So if you remember, it was AT&T, Ma Bell, big company, and regulations came in and it broke up Ma Bell because it was a monopoly. It broke into, I want to say, 25 companies. I should have that number. And then in the Clinton administration, they reversed all of the regulations, and it became a deregulated industry. And so you saw GTE, some of these names you may recognize, SBC. You now then started to see them reconsolidate, and they reconsolidated with Verizon and AT&T. So you saw a breakup and now consolidation again. The other thing is high debt. So really after the financial crisis, you started to see debt transfer from the private industry, which still has quite a bit, to the public. So you're seeing at the municipal level and at the government level, the numbers, the amount of debt is higher. This is actually, again, not healthy in the long run. I mean, the good news is the United States has the ability to print money. That's also the bad news, because printing money is creating inflation to get ourselves out of this debt. Supply chain disruptions. This is something we've been talking about for a little over a year. There's no question that, unfortunately, this trend around supply chain disruptions, I don't see that changing. There's a number of reasons. People will point to the trucker convoy. That's really, not the reason for this. This has to do with, I think, more issues of political, let's call it global issues, issues with China. Yes, the kickoff was the coronavirus, but you see this actually not getting substantially better. It's actually getting a bit worse in certain sectors. Hyperinflation, eventually leading to stagflation. So that's a area where inflation is substantially higher and growth is slower. Now, growth hasn't really slowed significantly, but what you are starting to see is some of the leading economic indicators indicating that there's a slowdown in the offing. Now, I'm going to talk to these a little bit more. Civil unrest, again, talked about how the consolidation to the top is an issue, but you can see these mandates and things like that are creating some strife in our society. So that's all, and it's happening globally. And I'm going to show you some charts as it relates to that. But let's talk a little bit about the consolidation to the top. There's been a number of steps that have been taking place over multiple decades that has created this problem. So you can see like the corporate profits have been going substantially higher. Now, part of that is share buybacks, lift corporate profits. Part of that is also has to do with, lower taxation for these companies. But a lot of what you see here had to do with a significant amount of share buybacks, which yes, okay, it increases the value of the stock, but it really actually enriches a lot of the senior management in these companies as well, because they tend to be pretty significant shareholders in this. So you can see share buybacks here, direct correlation. So if we actually pulled back share buybacks, you will see when that happens, like you see here to here, you can see the dips. Okay, that's what generally happens. The difficulty, the hard thing from my perspective that I see is that the change in revenue for small businesses is really not so great. And small businesses have been the lifeblood of our economy. It accounted for 60 to 70% of employment in our country. So when you see their share of revenue not looking so good, that is not good for the long run. And certainly coronavirus has made that, the mandates have made that, and understand this isn't pro con or anything like that. I'm just very factual. I look at data, I look at facts. These things, these mandates are, affecting significantly the small businesses. Now, as a small business owner, I can tell you, and I have several small business owner clients, we are all experiencing the same thing. Costs are going substantially higher. It is harder to do business for a number of reasons. There's a lot more regulation, like in this industry, there's a lot more, and a lot of it is truly nonsensical. It's not helping you, the client, any more than it's just creating more paperwork and actually just tying things up. So as a small business, we're experiencing, and I'm just going from my perspective, but you can see this across the board, we're experiencing heavier regulation that's also creating, compressing margins as well. And that's happening a lot in a lot of different industries. So what does that do? That weakens small businesses. Meanwhile, larger businesses, under Obama administration, corporations now have the same constitutional rights as humans, as us. And with that came, I really feel that a lot of regulations, a lot of things that transpired after that just continually put more power in the larger companies. Now, again, why is this a big deal to me? Well, this is a big deal to me because in the long run, and I think we're starting to see that now, that becomes destabilizing to an economy. So this is why I bring this up. Supply chain, Paul and I pointed this out last month. He's actually on vacation these next 3 days. We pointed this out last month. You can see that, inventory continues to be an issue. You do see that there's really been no significant reprieve for the chips that go into the cars. That's still a definite issue. Inflation, again, I don't know if many of you pay attention thematically to some of the things we've been saying over the years, but one of the biggest things we're talking about and have been talking about for a long time is that inflation, well, in September last year, for sure, we said inflation is not transitory. It is not transitory. Now they finally realize it isn't transitory. What I'm concerned about is that this time around, and I think finally the Fed admitted it today, this time around, fighting inflation is going to be much more difficult because it's happening in our necessities that we have to have. So if the Fed were to increase interest rates, which they're going to do, presumably we still need to demand the same amount of food, the same amount of water, the same amount of electricity, the same amount of gas to heat our homes, to, put lights on in our homes. Insurance, like car insurance, you're seeing premiums go up. So it's the biggest concern I have is that we're starting to see this inflation, not starting, it is in the things that we need. How much could the Fed, if the Fed raises 1%, 2%, 3%, how much is it going to really affect what we need? In fact, again, I might have said this last time, we were going to start an ag fund back 10 years ago because our thesis was that the price of food was going to go substantially higher and that at some point the farmers will be the new Wall Street, meaning they will be able to command higher prices. We do actually think that's going to happen with time. So you could see these numbers here. What this shows is this is shadow statistics. This is their number of where inflation really is. They're saying it's somewhere in the high 10s. I don't disagree. I want to show this chart. So this was, again, this is as it relates to social tension and civil unrest. And this was the chart that we showed you last month or the month before. No, excuse me. This was in November. November, we showed this chart. And you can see, there's these dots. This is, different protests. The orange dots here are riots, okay? So I just want to see if I can get to a current shot for you. Let me see if I can find that. So you can see here, the last chart that I just showed you, it did have these yellow dots. These yellow dots are like mini battles, mini skirmishes. You can see here the increase in unrest we all know what's going on in Canada. In Canada, that was not existent on that chart in November. Okay, so some of the colors are changing. So it's it's starting to accelerate. You can see a little bit more violence, the lighter blue, a little bit more violence against civilians. And then, notably the change here in Canada too, for the protests, the recent protests. Okay, so I just wanted to show you, you can see, look at nothing in Canada. Yeah, and very little yellow. You do see orange here. Okay, so that's changing. That's something that's now occurring. You can see that this chart to me is a little daunting. This next slide here, if you remember in October, one of the concerns that I brought up was vaxxed, unvaxxed, this whole, social tension around this. And this was a demonstration in Italy, dock workers getting very upset that, they don't want a green pass. So many of these dock workers are vaccinated. They just didn't believe in the mandates. So we can see that now these demonstrations are accelerating literally across the globe. And again, this becomes destabilizing. Why? A number of reasons. One, it's going to affect our supply clearly because it's the truckers, but it's beyond that. It's now, there's talk about, martial law. Okay, I mean, this is the conversation now that's taking place. So what I see, in summary, I see that supply issues are going to persist. This is what I believe is going to happen, especially as we have some issues with potential war, this discussion. Oil, again, one of our longer term prognosis is that oil is going to easily fly over $100 a barrel, 150. When I look technically at the charts of where oil could actually possibly go, 150 is very possible. Again, the Fed won't be able to control inflation very easily. I don't think that's going to be easy for them to do. And then from a medium-term perspective, the quality of healthcare is deteriorating already. Institutions will experience stress. So because we have such high inflation and as well, we have such a high debt situation, I think that's going to start bleeding into the quality of healthcare. We have so many healthcare workers leaving their positions, and that's a problem longer term. Or medium term. And long term, I do think that the dollar is at risk to lose its reserve currency status. And if it does do that, then, in the long run, in a short run, the moment that happens, then, we will experience our prices going higher. So how do we position in the face of something like this? We're going to go for the sectors with pricing power. So you can see like energy is something that we have pretty good exposure to, an alternative energy, water. We're going to look at, things like we love technology, but this isn't the time for technology. It's time to just really go towards lower volatility stocks. So like things in financials, you'll see we own financials because we know premiums have pricing power. So, insurance premiums have pricing power. That's good. If banks are positioned properly, they can benefit from higher rates. So the smarter companies that are prepped for that, those look attractive. Energy looks attractive. And, anything like that would, again, we tend to like the cryptocurrency. We think long-term, that's a good buy. That really, those are the areas of focus for us. Utilities, like the things that we absolutely have to have. And you can see, like, if you look, those sectors are actually outperforming this year, which is great. Now, having said that, I think many of you know that I've talked in the past about the fact that right now we have a significant amount of cash. We feel like that is the best place to be right now. We may take a hedge, which would mean we would take a very conservative short, like insurance, that if the market went down, that you'd have some cushion in the portfolio. We're looking at that as an option for you. We actually like the master limited partnerships, which is the gas companies. So there's areas that look attractive right now, given where we are. But when you look at the market as a whole, and I can show you here, I scroll through, this is, let's see if, yeah, okay, excuse me. This is, daily, I go through these charts every single day. These charts, so represent every single sector and every single industry within the S&P 500. And one of the things I want to look at is how is everything trending? What sectors look good? So if you look across the board here, this is okay. I'm not seeing trends. This is how everything's trending. Netflix looks awful. That just got bought out. Twitter, you can see Facebook, horrible. Google, Google's okay. Twitter, publishing, neutral at best, negative to me, really. Telecommunications, for just really not doing great. I mean, this is not a bull market. So when I scroll down the S&P 500, and I look at this every single day, when I scroll down this, and Paul looks at different aspects of it. But when I scroll down, you can see that the majority of stocks are either hitting new 52-week lows or definitely breaking down, the majority being 90%. That is not, if you remember, we talked about this before, that is not a healthy market. So let's take a look at something else. If I look at what's going on in energy, you can see the energy patch looks great. Why? Because it has substantial pricing power. This is where we want to be. So you can even see, some of the utilities are looking better as well. It's not looking like the other ones. Okay, so I'm going to open this up for questions. Let me just get out of this share. If you have any questions, you can actually raise your hand or type it in the bottom. And I think I could actually unmute you so you'd be able to ask the question. Okay, please go ahead and ask your question.
So what do we do going forward, Alexandra?
Well, as I said, what I'm doing is we have, a good amount of cash in the portfolio. Again, it takes patience. This isn't something where you just say, okay, it's, sometimes it's better to just stand still and not react too much by saying, I want to buy, I want to be in, get me income. That's what we'll hear a lot of, like, we need more income. Sometimes it's just better. And then there's many of you who are with me who've been with us a long time. Sometimes it's better to just pause. So we're pausing, but we are buying those sectors that we think will do okay. Like I said, like in energy and in utilities and, staples, something like, Procter and Gamble. I mean, nothing sexy, but really sticking to the high I would say like really high quality blue chip companies.
I'm okay with pause.
Pause sometimes is the best.
Yeah.
Anybody else for a question? Okay. Bill, I think you said you had a question? Or no? Maybe not. Okay, I thought you had a question. Okay, anybody else for some questions? There's got to be something out there. You can type it or you can ask to. Okay, well, no one else is raising their hand, so you're making this really easy for me, but you do know you can call the office. I'm here right now. I don't have another appointment until 4 o'clock, so I'll be available to pick up the phone if you want to ask in private, 236-2980. And, you know, again, I'm just asking for patience. If you would just also do us a favor, just give us some comments about what is helpful about these meetings and what is not, like what you may want to see more of. Please let us know, because this is for you. This is so you know what's going on, so you have an idea of where we stand on everything, and you can gauge how we're working with your portfolio. But if there's something more you want to see, something, you know, whether it's more graphs or break things down, we need to know. We need that feedback from you. Okay, so thank you everyone so much. You made this really easy for me today. I'm surprised I was able to run this on my own, but I did it. Okay, so I'm here, and give a ring if you need anything from me. Okay, thanks so much.